You hear about inflation all the time, right? But the latest numbers, well, they're hiding a really surprising story. So today, we're going to break down what the December inflation report really means for the economy, and maybe more importantly, what it means for you.
And this is it, isn't it? This is the question on everybody's mind. The official reports say inflation is cooling off, but then you go to the grocery store or fill up your car and it just doesn't feel that way. So let's get to the bottom of that feeling.
Okay, so this is the number you've probably seen in all the headlines. The official annual inflation rate for December of 2025 was 2.7%. All that means is that, on average, prices were 2.7% higher than they were exactly 1 year before. But, that one number, it never really tells the whole story. To actually understand what's going on, we need to peel back the layers and see how these figures have been changing over the past year. So if you look back at 2025 as a whole, there's definitely been some real progress. We started the year with inflation at 3% and ended at 2.7%. And even better, core inflation, that's the one that takes out the super volatile food and energy prices, it saw an even bigger drop. But the main takeaway here is that even though things are moving in the right direction, inflation is still stubbornly high. So, if the overall rate is coming down, what's stopping it from falling even further? Let's dig into the specific things that are really putting the pressure on all of our budgets. And if we zoom in on just the month of December, you can see exactly where that pressure came from. We saw these sharp jumps in both food and energy prices in just that 1 month alone. But behind those ups and downs, the biggest, most persistent problem continues to be the cost of housing. And this is where we see a bit of a worrying trend, at least in the short term. The pace of inflation actually sped up in December. It rose 0.3% from the month before, which is a big jump from November's 0.1% increase. And it's these little monthly accelerations that are keeping that big annual number from falling any faster. Okay, so that's the story the numbers are telling us on the surface. But, and this is a really big but, there's something else going on. A kind of glitch in the system that we really need to understand to get the real picture.
Yeah, the figures we've been looking at might be the clearest we've had in a few months, but they're still not entirely accurate. There are these lingering distortions that might be painting a slightly rosier picture than what's actually happening.
Remember that government shutdown late last year? Well, it turns out that 6-week shutdown had a direct impact on how the government even collects its price data. For October and November, the whole process was seriously disrupted, and that created some really odd results in those reports. And to see why that shutdown matters so much, we have to talk about something called the shelter index. Basically, it just measures housing costs, but here's the kicker. It is the single biggest piece of the entire inflation puzzle. It has more weight than anything else in the calculation, so any error there has this huge ripple effect. And this is the glitch. During that shutdown, the Bureau of Labor Statistics just couldn't collect enough new data on rent. So for the month of October, they kind of carried over old data, and that resulted in an official assumption that rental inflation was zero. Who here has seen their rent go up by 0%? Yeah, didn't think so. And the effect of this is actually pretty significant. Economists figure this data problem is making the real inflation rate look about 0.1 percentage point lower than it truly is. And because of the weird way they collect the data, this little distortion won't be fully fixed until April of 2026.
So, with all that in mind, where do we go from here? Well, looking ahead into 2026, the economy is basically in this giant, fascinating tug of war, with some things pushing prices up and other things trying to pull them back down.
Because of this economic push and pull, the general thinking is that inflation is probably just going to hang out in this range for most of 2026. It's not expected to spike way up, but it's also not expected to fall back to what we used to think of as normal anytime soon.
So let's look at the two teams in this economic tug-of-war. On one side of the rope, you have forces like tariffs on goods and worker shortages all trying to pull prices up. And on the other side, you've got forces like falling apartment rents and the growing impact of AI, which are trying to pull them back down.
Let's look a little closer at what's pushing prices up. Tariffs are already causing price spikes on things like coffee and appliances. Plus, a lot of businesses have been eating those higher costs themselves, and they might decide to start passing them on to us in the new year. We're also expecting to see worker shortages in places like restaurants and hotels, which could push wages and then prices even higher. Okay, now for the other side of the rope, the forces pulling prices down. Tighter immigration policies are actually leading to a surplus of apartments in some areas. That means vacancy rates are up, and landlords are more likely to lower rents just to get people in. And then there's the really big new factor, AI.
Economists believe that as more companies use artificial intelligence, it's going to start putting downward pressure on wage growth. So we've looked at the numbers, we've talked about the data glitch, we've seen the forecast for next year, but now let's bring it all home and connect this complicated economic picture back to our actual daily lives. Because this is the bottom line, right? After all the charts and percentages, we need to answer that first question we asked. Why do things still feel so darn expensive?
You know, an economist from NerdWallet, Elizabeth Renter, said something that just hits the nail on the head. She said people are more sensitive to price levels than they are to inflation, and it's going to take a lot longer for that pain to go away.
And this right here is the crucial takeaway from all of this. Lower inflation doesn't mean prices are going down. It just means they're rising more slowly than they were before. The high prices we've all been dealing with for the past few years, they're still here. That car, the groceries, the rent, they're all at a higher plateau, even if they're not climbing as fast anymore. And that is the financial pain we're all feeling.
So that leaves us with the big question for 2026. We've got this giant economic tug-of-war going on between all these competing forces. And at the end of the day, the real test, the only thing that really matters, is whether our wage growth can finally outpace these stubborn price levels and give our wallets a much-needed break. That's the story we'll all be watching.